Ajay Vora of Nuvama is joining us now to talk more about numbers. Ajay, afternoon. Thank you so much for your time. Quick take on Pharma because we were discussing about it some time back. I want to understand from you when you interact with your large clients, not just DRL, which is taking it in the chin. Yesterday, we were speaking with Lupin. I clearly remember Vinita Gupta telling us that pricing pressure in US is going down, margin outlook is improved, and growth, very high double-digit growth in US. What applies for Lupin should ideally apply for DRL as well, but that one got very badly hit in this quarter. What are your thoughts? Is there institutional appetite coming for Pharma back, or it is very patchy and very mixed?
So, hi, good afternoon, Ajay, and thanks for having me on the show. Talking about pharma, as we discussed last time, also, it's more of a stock-specific sector. You cannot have a generic trend across all the names. But the broad, theme, what we saw maybe few quarters back, is that a couple of very large companies in US having a generic portfolio, they had started giving a very strong commentary about their overall business. So in fact, last quarter, a couple of companies upgraded their guidance, and they were also turning pretty positive on the overall margin profile. And if you relate the same thing to, most of the Indian players having US business, and they have pretty large, right from $1 billion to $2 billion. That particular portfolio over last 6-7 years, if you look at it, has gone nowhere, and in fact, it has gone lower only. So now, if you start evaluating these companies, if you look at the valuation of the India business, or maybe I would say ex-US business, if you strip the US business and evaluate the whole company, they were available at a very reasonable valuation. I would say commodity kind of a valuation, and that is when you would, as you rightly said, some sectors when they get into a value phase, institutional investors start looking at it in a very positive manner. So we strongly felt that the few companies were available at 3, 4, 5 times EV to EBITDA, and that was a good level to get in. Where we have seen a decent returns over last 3 months. Few stocks are up around 40-50% over last 3 months, 4 months. So that is the kind of outperformance we have seen in this sector.
Would L&T interest you? What do you make of the commentary coming from L&T that margins pressures transitory, and in the second half margins will start improving? The stock has done pretty well in the last 2-3 months, and the order flow has been good. It's just a result based. How did you read the commentary after the results? Did you manage to have a look?
So Ajay, if you look at it, L&T is actually a mammoth, right? It's so large, and so many moving parts to it, and so many different verticals. I feel that the whole margin improvement or margin deterioration always happens with a lag, and therefore whatever we saw in the first half over last 1 or 2 quarters, I think that is what has happened, where the raw material prices have started coming off, but I think the benefits will accrue in the next few quarters. So that is the reason why you saw that kind of commentary from the company. But as I said, that it is a mammoth, and on that particular size, to grow at 20-25% becomes pretty unrealistic, and therefore I think even a 10-12% guidance for order inflow and 12-15% for revenue, it's a decent guidance going forward for a large cap company.
Okay. What are your thoughts on IT? Are you of the belief that one has to be very careful in IT, mid-cap IT or something you like? I was just looking purely on the data. 17th of March, when the Infosys results were declared, which was a big miss, every IT stock, mid-cap, large cap, small cap, were down 10-15%. But since then till now, bulk of them have given 10-20% returns as well. Is that area coming under value zone yet or not yet?
So Ajay, to be very frank, we have been in a wait and watch mode for this particular sector. We strongly feel that US is struggling big time, and the challenges are just increasing over there. The way stocks have corrected in IT sector, there would be a set of investors who would find value after a 30-40% correction. But my view is that we would be more constructive only when we start seeing bottoming out of the earnings downgrade, and where we see valuations also pretty reasonable at that point of time. Right now, if you look at it, although the stocks have corrected, that is more to do with the overall, PE contraction. Because if you look at, mid cap IT names, they were trading at somewhere close to 35 times earlier. Now they are still trading at closer to, 23, 24, 25 times. I think that, if the whole growth rate struggles in US with most of the large banks and even smaller banks, the tech spend can take a hit. And I don't think we should be in a rush to get into this space just looking at the stock price correction. I think that we have to look at the commentary from the US businesses on whom these all these IT companies are dependent. Only then where we see bottoming out of this whole cycle is when we would be more constructive on this space.
Fair point. Ajay, what are your thoughts on banking? If we split the private sector performance this quarter, which was very good, ICICI, Axis, HDFC, Kotak also, PSU was a bit kind of softish. And then to make matters worse, yesterday we saw the ECL issue. Though we got clarification from Canara and many others that expecting 5% is, too much exaggeration by the street. At max, an impact of 1 to 1.5%. But how would you go for value hunting in PSU banks, or you would stick to the large cap kind of very operationally strong private sector banks?
So I think, Ajay, if you look at the overall return profile and the whole matrix also, private sector banks still stand out significantly. And, that also got proved in current quarter. So, there are two, three big matrix which you should ideally look at. One is, if you look at their profitability, which is the NIM trajectory of most of the private banks, that is significantly higher versus the PSU banks. And at the same time, if you look at the return ratios, like, the whole ROA, ROE profile, that still is looking far attractive for most of the private sector banks. And Ajay, just to add to that, the whole space, actually, the whole private sector banks or public sector banks, the whole space is now entering into a phase of, a reasonably higher growth versus what we have seen earlier. So, we went through a phase of systemic credit growth of around 5-6% for a fairly long time. Now we are somewhere around 13-15%. So most of the banks will have their own share of growth, but most importantly, all these banks are entering this phase with solid learnings from the past cycles in respect to, with respect to everything, be it, the underwriting, be it managing the profits or the section where they should be targeting. So I'm saying that the learnings has been so solid from the last cycle that, most of the banks will end up doing well in the current growth cycle. And India is doing pretty well relative to the entire world. So I think the way investors have especially the FI community has sold the banking sector over last 2 years, I think once we will see a reasonable reversal of that flow, this whole space should ideally start outperforming in a very big way.
Right. Ajay, have you looked at some of the NBFC's performance this time? The non-traditional ones, MFIs, be it Mass Financial, Spandana Spurti, Saturn Credit, You Grow. One really observed that the growth was good and asset quality appeared to be in pressure, in check, under check. Any thoughts here, since that we are talking about lenders?
So we like a couple of names, especially in the microfinance space, which you spoke about. And, a large one was struggling quite a lot over, I would say, last 12 to 18 months. And in terms of provisioning, which they had taken, was pretty significant. So, the stock had also underperformed big time and was trading at very cheap valuation. Considering, what you said and also what we are seeing at the ground level, things have picked up, and considering the pessimism which was there on the provisioning side, that is also easing off. So I agree with you. Few names in that space are still looking good considering cheap valuations. And most important thing is the interest rate cycle is also reversing. So both the things, the growth is picking up and interest rate cycle is reversing. That actually plays pretty well for this whole space.
Give us something else to chew on. What have you been researching or advising your friends? Anything in the last couple of weeks? Anything interesting came across?
So Ajay, we have turned positive, and a couple of quarters back on the whole discretionary side. Mainly, if you look at auto and auto ancillary, that was something which was looking very attractive. And especially if you look at, the whole export focused two-wheelers or even the auto ancillary, the tire stocks, the trajectory over last, I would say 6 to 8 quarters has changed significantly. So just to give you, a perspective over here, one of the large tire companies, they were doing an operating profit of say somewhere around 600 crores odd, at a quarterly level for a fairly, 5 6 quarters. But suddenly, over last 2 quarters, that trajectory has changed from 600 crores to almost 1,000 crores. So that is the kind of growth which we have seen, and therefore the stock has also done exceedingly well, irrespective of the market volatility. So we are positive, and similarly, on the two-wheeler side also, if you look at it, players which are export focused, the whole mix is changing, the margin profile is changing, and valuations were pretty cheap at that point of time. So we have seen reasonable outperformance in this space. And barring, auto ancillary, there are pockets of discretionary sectors which has, again started doing well. So we are pretty positive on this whole consumer discretionary also in specific pockets.
All right. All right, Ajay, we'll let you go on that one. Thanks so much for joining us on
Thanks,
the show
bro.
today. That is Ajay Vora of Nuvama. Let's go across.